Hi everyone, welcome to our channel, Wealthy Ways. Today we're discussing inflation, and many need help understanding this concept. Hence, we're here to break it down, and hopefully, after this video, you will have a much better understanding. Before we get to inflation, let us briefly cover the meaning of macroeconomics. Macroeconomics is the study of the economy as a whole, focusing on topics such as growth, unemployment, and inflation. Inflation refers to the general increase in prices of goods and services over time. It is one of the critical variables that macroeconomists analyze. The relationship between macroeconomics and inflation is vital because macroeconomic policies and conditions can significantly impact the rate of inflation in an economy. For example, suppose a government adopts an expansionary fiscal policy, such as increasing government spending or cutting taxes. In that case, this can lead to higher demand for goods and services, which in turn can cause prices to rise and result in inflation. Conversely, suppose the government adopts a contractionary fiscal policy, such as reducing government spending or increasing taxes. In that case, this can decrease demand and lead to lower inflation. Similarly, changes in the money supply, interest rates, and other factors can also influence the rate of inflation. Macroeconomics seeks to understand these factors and their impact on the overall economy so policymakers can make informed decisions to maintain price stability and promote economic growth. Inflation is a macroeconomic concept that refers to the general increase in the prices of goods and services over a given period of time. It is usually measured by the Consumer Price Index, which calculates the average price change of a basket of consumer goods and services. When the average price level of a basket of goods and services rises over time, we say that inflation has occurred. In macroeconomics, inflation is seen as a crucial indicator of the health of an economy. It is often used to measure the overall cost of living and assess the purchasing power of money. When inflation is high, it means that the cost of living is increasing, and people need to spend more money to buy the same goods and services they used to buy at lower prices. This can be a problem because it reduces the purchasing power of money and can lead to a decrease in consumer spending and economic growth. There are several causes of inflation, and economists generally categorize them into two broad categories: demand pull inflation and cost push inflation. Demand pull inflation occurs when there is too much demand for goods and services in the economy, leading to a rise in prices. This can happen when the economy is growing too quickly and people have more money to spend, causing them to bid up the prices of goods and services. This can also occur when there is a shortage of goods and services, leading to higher prices as people are willing to pay more to get what they need. Cost push inflation occurs when the costs of production rise, leading to higher prices. This can happen when there is a rise in the cost of raw materials, labor, or energy. When these costs go up, producers pass the extra costs on to consumers in the form of higher prices. This type of inflation is often referred to as supply-side inflation because it is caused by factors that affect the supply of goods and services in the economy. Inflation can have both positive and negative effects on an economy. On the one hand, inflation can stimulate economic growth by encouraging investment and consumption. When prices are expected to rise in the future, people are more likely to spend money today to take advantage of lower prices, which can drive demand and boost economic growth. In addition, inflation can also help reduce the value of debt, making it easier for people and businesses to pay back loans. On the other hand, inflation can also adversely affect an economy. For example, it can reduce the purchasing power of money, making it more difficult for people to afford the goods and services they need. In addition, inflation can also lead to wage and price spirals, where workers demand higher wages to keep up with rising prices, which in turn leads to higher prices for goods and services, and so on. This can lead to a vicious cycle of increasing prices and declining economic growth. Inflation is a crucial macroeconomic concept that measures the general increase in the prices of goods and services over time. It is caused by various factors, including demand pull inflation and cost push inflation, and can have both positive and negative effects on an economy. Understanding the causes and effects of inflation is vital for anyone who wants to understand better how economies work and how to build wealth over the long term. Let us briefly touch on quantitative easing and its correlation to inflation. Quantitative easing is a monetary policy used by central banks to stimulate an economy by increasing the money supply. This is typically done by purchasing government bonds or other financial assets from banks, increasing the bank's reserves and allowing them to lend more money. QE aims to lower interest rates and stimulate borrowing and spending, thereby boosting economic growth. Inflation refers to a sustained increase in the general price level of goods and services in an economy over a period of time. It reduces the purchasing power of money and can lead to higher costs for consumers. If inflation is too high, it can be a sign of overheating in the economy and can lead to economic instability. Quantitative easing can impact inflation in several ways. On one hand, by increasing the money supply and lowering interest rates, QE can lead to higher inflation if it substantially increases spending and demand. On the other hand, if QE is implemented in a weak or contracting economy, it may not lead to higher inflation if demand remains low. Central banks typically monitor inflation and adjust their monetary policy accordingly to ensure it remains within a healthy range. Now, let's get back to our main topic of inflation. How can inflation be monitored? There are several ways to monitor inflation and keep track of it. The first one we touched on a bit at the beginning of this video. Consumer Price Index. The most widely used measure of inflation is the Consumer Price Index, which the Bureau of Labor Statistics published in the United States. The CPI measures the average change in the prices of a basket of consumer goods and services over time. It is an excellent way to keep track of the overall cost of living and see how inflation affects the economy. Inflation reports. Many central banks and government agencies publish regular reports on inflation. These reports provide detailed information on the latest inflation trends. They can be a good source of information for anyone who wants to stay informed about inflation. Economic forecasts. Economists and financial analysts often make predictions about future inflation trends. These forecasts can be helpful for people who want to plan for future inflation and make investment decisions accordingly. Financial news. Inflation is often discussed in financial news and analysis, and it is a common topic of discussion among economists and financial experts. Keeping up with financial news can be an excellent way to stay informed about inflation and see how it affects the economy. Personal experience. Finally, you can monitor inflation by keeping track of the prices of goods and services you buy regularly. By paying attention to the prices of things like food, gas, and housing, you can get a sense of how inflation is affecting your personal finances and the cost of living in your area. It is crucial to remember that while inflation can present opportunities for wealth generation, it can also bring challenges and risks. For example, during periods of high inflation, the value of money decreases, which can reduce the purchasing power of consumers and investors. In order to successfully generate wealth through inflation, it is essential to have a long-term investment strategy and to be prepared to adapt to changing economic conditions. There are several ways to generate wealth through inflation. Invest in stocks. One of the most common ways to generate wealth through inflation is to invest in stocks. When inflation is high, the prices of goods and services also rise, and many companies benefit from this. By investing in stocks, you can profit from the increase in company profits and share prices that often accompany high inflation. Invest in real estate. Another way to generate wealth through inflation is to invest in real estate. When inflation is high, the prices of properties generally rise as well. By buying real estate and holding onto it over the long term, you can potentially benefit from the appreciation of your property due to inflation. Buy commodities. Commodities such as gold, silver, oil, and other natural resources can also be suitable investments during periods of high inflation. Commodities tend to hold their value well during inflationary periods because they are in high demand, and their prices tend to rise along with inflation. Invest in bonds. Investing in bonds can also be a way to generate wealth through inflation. When inflation is high, central banks often raise interest rates to combat it. Investing in bonds can earn higher interest rates and benefit from the rise in interest rates during inflationary periods. Diversify your investments. Finally, it is important to diversify your investments in order to generate wealth through inflation. By investing in a variety of different assets, you can reduce your risk and benefit from the strengths of different investment types during different inflationary environments. There are several ways to generate wealth through inflation. By understanding the relationship between inflation and different types of investments, you can make informed decisions about allocating your resources and building wealth over the long term. In conclusion, central banks, such as the Federal Reserve, play a crucial role in controlling inflation through the use of the monetary policy. For example, suppose inflation is too high. In that case, a central bank may raise interest rates, making it more expensive to borrow money and slowing down economic activity. It's important to note that some level of inflation is considered healthy for an economy, as it can stimulate growth and encourage investment. But if inflation gets out of control, it can lead to economic instability and hurt individuals and businesses alike. Understanding inflation is key to making informed financial decisions. Make sure to keep an eye on inflation rates and how they may impact your investments and spending power. In addition, it's essential to diversify your investments and consider inflation hedging strategies, such as investing in assets like real estate or commodities, to protect your wealth against the erosion of purchasing power. And remember, keeping informed about macroeconomic trends and developments can significantly benefit your personal finances and investment portfolio. Thank you for watching Wealthy Ways, and we'll see you in the next episode. Stay tuned for more wealth building tips and strategies.